Today, I want to take care of one sum on dissolution of a partnership firm. Read this sum on the screen. Meg, Mayur and Malhar are partners sharing profits and losses in the proportion of 6:3:5. Their balance sheet as on 31st of March 2010 was as under. On liability side, you are given the capital account of Meg, Mayur and Malhar and current account of Meg and Mayur, but there is a debit balance for Mayur, 49,000. Meg and Malhar has got credit balance on current account. So here partners are having two types of current account, fixed capital account and current capital account. One of the partner has a debit balance. On asset side, you are given land and building, and there is a mortgage loan on land and building. So land and building 1 lakh, realized 60,000, and from this 60,000 realized value, you have to pay first of all the mortgage loan 40,000. Because this mortgage loan have a charge, has a right on the realized value of land and building. On liability side, you are given creditors also. It was decided to dissolve the partnership firm on the date of balance sheet. The assets of the firm realized as follows: land and building, furniture, stock and debtors. You are given the realized value. The expense of dissolution was 20,000. The creditors agreed to receive 75 paisa in a rupee in full settlement. Mortgage loan was paid off. Mayur was declared insolvent and only 40 paisa per rupee has been received from his personal profit. Now, see, one of the partners is insolvent and whatever the amount is due from that partner, firm could recover only 40% thereof. You are required to prepare realization account and bank account, capital account, partners capital account, and you are required to apply the decision of Garner versus Murray. Now, for the purpose of accounting for this dissolution, we are required to apply the decision of Garner versus Murray. Now, understand one thing: the Garner versus Murray decision is applicable when one of the partner is insolvent. Second, that partner is unable to bring, or that partner is unable to pay his obligation towards the firm. So, this partner who is insolvent has a debit balance of capital account and the amount is not recoverable from him. In such situation, Garner versus Murray decision is applicable. The amount so not recoverable from the insolvent partner is not a bad debts, because the partner is not a customer to whom the goods have been sold on credit. So you can't treat this non-recoverable amount from an insolvent partner at par with bad debts. But the name of that non-recoverable amount is capital deficit. And Garner versus Murray says that this is a capital deficit, so it should be borne by the partners, not in the profit sharing ratio of 6:3:5, but it has to be that loss, capital deficit of an insolvent partner has to be borne by solvent partners in the proportion of their capital that existed on the date of dissolution. Now, which capital? Fixed capital or current capital or both? The answer to the question is, you have to consider the proportion of fixed capital of solvent partners for the purpose of transferring the loss on account of capital deficit of an insolvent partner. One more thing that is also prescribed in Garner versus Murray's decision is that solvent partners are required to bring cash equal to the realization loss suffered by them. This is a brief story of Garner versus Murray's decision has been mentioned to you. Now let me start with the sum. Here I am going to prepare necessary accounts. The necessary accounts are realization account, capital account, partner's current account, cash account. First step for the purpose of solving the sum is to copy the balance sheet or consider the details of balance sheet in this respective layout. all the assets to be realized are transferred to realization account and the realized value credited in realization account. All liabilities to be settled are credited to realization account. Amount settled for the liability, we paid for the liability, debited to realization account. Any other expenses, dissolution expenses, etc. will be debited to realization account. Realization account is prepared to find out the profit or loss on realization of assets and settlement of liability at the instance of dissolution. Partners capital account, and here I have prepared cash account. Let me start first of all with the balance sheet. Look at the balance sheet. Land and building 1 lakh debited to realization account. Furniture 50,000 debited to realization account. Stock 2,31,000 debited to realization account. Debtors 3 lakh debited to realization account. Notice it. Cash balance will appear as opening balance in cash account. Current account of Mayur will be transferred to the debit side of Mayur's current account. These are the current accounts of the partner. Mayur holds a debit balance. So this debit balance appearing on the asset side is recorded as 49,000 opening balance in the current account of Mayur. Now I want to consider the liability side of the balance sheet. Notice capital of Meg 2,50,000. Capital of Malhar. Now Meg and Malhar are the solvent partners and Mayur is an insolvent partner. Current account of Meg and Malhar are transferred to the credit side of current capital account. Creditors 3 lakhs credited to realization account. Mortgage loan is also transferred to the credit side of realization account. This is how I have considered all the details given in the balance sheet. How it has been considered. Capital balances, fixed and current, are transferred to the respective capital accounts of the partners. Assets to be realized are transferred to realization account. Liabilities to be settled are credited to realization account. Cash balance is recorded in cash account. Now, this is a sum on Garner versus Murray. The capital deficit of an insolvent partner should be borne by solvent partner with the ratio of capital. So first let me find out the capital ratio on the date of dissolution of the firm. So find the capital ratio of solvent partners on the date of dissolution. And here, notice that 2,50,000 and 1,50,000 ratio is 5:3. So capital ratio of solvent partner is 5:3. We should consider the fixed capital balance for the purpose of finding out the ratio. This current capital balance should be ignored for the purpose of finding out the capital ratio. Notice this is an important point. Now realize the asset. All the assets are to be realized. What is the entry for realization of asset? Entry is cash account debit, land and building realized 60,000 to realization account credit. Now understand one thing. I am a teacher and writing and solving the sum here before you. Allow me to write the abbreviations because of the space constraint, because I am required to accommodate all these things on a small screen. So permit me to write the abbreviations instead of building. Allow me to write BUI, but understand that it is building. And when you happen to write an examination, write the full form. Now land and building realized 60,000. This land and building is mortgaged. So from these proceeds, you have to pay the loan. So mortgage loan was paid off. Okay, when the loan is paid off, realization account debit to cash account credit. So from 60,000, 40,000 loan could be paid. Balance is available with the firm to account for dissolution of a partnership firm. Now next, furniture realized 120,000, cash account debit to realization account credit. Then stock realized 50,000, cash account debit to realization account credit. See, this furniture account is transferred to the debit side of realization account. The realized value credited to the furniture is transferred to the debit side of realization account. The realized value is credited to realization account. Difference between this book value and the realized value shows you the profit. Debtors realized over 2 lakhs. So cash account debit to debtors account credit 2 lakhs. See, the debtors are 3 lakhs, realized 2 lakhs, loss is 1 lakh. This is how automatically loss of 1 lakh on realization of debtor is debited to realization account, if you consider 3 lakh debit and 2 lakh credit, net 1 lakh loss is debited. Now, after realization of assets, pay dissolution expense and liabilities. How much is the dissolution expense? Is 20,000. What is the journal entry for its payment? Realization account debit to cash account. Then creditors are paid 75 paisa in a rupee. What are the creditors? 3 lakhs. 3 lakhs into 75%. It should be 2,25,000. This is the payment made to creditors. Journal entry for that is realization account debit to cash account credit 2,25,000. So total payment made 2,85,000. Realization account debit to cash account credit 2,85,000. So assets are realized, liabilities are settled. Now, the next step is to close this realization account, find out the profit or loss on realization of assets and settlement of liability. That loss will be distributed to the partners. It will be transferred to the capital accounts of the partners in the ratio of profit sharing. And remember, whenever you want to apply Garner versus Murray, this realization loss sustained suffered by the partners has to be brought by solvent partners in cash. So here total of debit side is 9,66,000. From that, if you deduct 7,70,000, the realization loss turns out to be 1,96,000. This 1,96,000 loss is to be distributed in the ratio of 6:3:5. This is the ratio of profit sharing is given to me in the sum. So 6/40 is the share of Meg, 3/40 is the share of Mayur, and 5/40 is the share of Malhar. So Meg, Mayur and Malhar share in realization loss is 84,000, 6/40, 42,000, that is 3/14 share, and 5/14, 70,000 is the share of Malhar in the loss. Now these losses are debited to the partner's current account, and then current account balance will be ultimately going to be transferred to the fixed capital account. So this loss is debited to current account. Now, realization loss has to be brought in cash. Who are the solvent partners? Meg and Malhar are the solvent partners. Their share in the realization loss is 84,000 and 70,000. That much amount they have to bring in cash. This is what is suggested by the decision of Garner versus Murray. But majority of the accountants are of the opinion that it is not inevitably necessary to bring in cash for this type of loss because they are insolvent. So cash account debit 84,000 to Meg account credit 84,000. Cash account debit 70,000 to Malhar account debit 70,000. So this realization loss is brought in cash by the solvent partners. Now, who is insolvent? Mayur is insolvent. How much amount is due from him and how much does he bring? Let us find out what is the amount that he could not bring, which is known as capital deficit. And the capital deficit will be distributed in the ratio of capital as at the time of dissolution of a firm, that is 5:3, and we have to consider the fixed capital ratio. So let me work out the capital deficit. 91,000 is the debit amount. There is nothing to the credit, there is nothing in the Mayur's fixed capital account. So this 91,000 is the debit balance, 40% amount is brought by Mayur. So 36,400 is the amount brought. Cash account debit to Mayur's capital account credit 36,400. The difference between this debit and credit is known as capital deficit. Let us work it out. Total of credit side 91,000. Total of debit is 0. So 91,000 is due. Against that he brings 36,400. That is 40% of the amount. The amount that he could not bring is 56,400. And this 56,400 is transferred to the fixed capital account of Mayur from current capital account. So my fixed capital account debit to current capital account credit. Now this 56,400 will be distributed in the ratio 5:3. So share of MAG is 56,400 into 5/8, that is 34125, and a share of Malhar is 56,400 into 3/8, so that amounts to 20475. This is a capital deficit borne by MAG and Malhar solvent partners. The entry for that MAG and Malhar's capital account debit to Mayur's capital account credit, Malhar's capital account debit to Mayur's capital account credit. So this is how capital deficit is debited to the solvent partner's capital account, and its benefit advantage is given to the credit side of Mayur account. So Mayur capital account will be closed now. Now MAG and Malhar's current account will be transferred to their fixed capital account. Total of credit side 94,000 minus 84,000. 10,000 is transferred to fixed capital account. Similarly here 75,000 minus 70,000. 5,000 is transferred to the fixed capital account. Now this ultimate fixed capital balances will be redeemed to dissolve the firm. So total of credit side how much? 2,60,000 minus 34,125. This is a cash payable to MAG account debit to cash account credit. Now next, Mayur's capital account agrees on the both the side, total is same. So far as Malhar is concerned, total of credit side is 1,55,000. From 1,55,000, 20,475 will be deducted. So amount payable to Malhar is 1,34,525. That is paid to Malhar. Malhar account debit to cash account credit. So cash account is credited for this payment. Now ultimately I am required to close this cash account. Cash account should agree. Total of both the sides should be same. If you make a total of debit side and credit side, you will find the total to be 6,45,400. So this total agrees. This is how sum on dissolution gets solved. The important point of this sum is that mortgage loan realized from that payment has to be made to the mortgage loan creditor immediately. And second important point, that capital deficit of an insolvent partner is distributed among solvent partners in the proportion of their fixed capital existed on the date of dissolution of the firm. I think you must have followed, you have followed this sum. Thanks to all of you.